Hey guys, my name is Evan, and welcome to Economics 101, your number one source for everything economics. What happens when the world's second largest economy suddenly wants more oil? Well, global markets start paying attention immediately because when China increases oil demand, it doesn't just affect energy company; it can affect everything: gas prices, inflation, interest rates, even Federal Reserve policy. In today's video, we're going to break down why China buying more US oil matters, what happens to prices and inflation, and how this could impact consumers and the broader economy. Before we jump into the video, I do have a quick favor that really helps grow the channel. If you enjoy simple breakdowns of economics, energy, and global markets, please hit the like button and subscribe so more people can find the channel. Now let's get into it. Why China's oil demand really matters? So China is one of the largest oil consumers on earth. The country uses huge amounts of energy to power manufacturing, to power transportation, to power construction. So when China's economy accelerates, oil demand often rises sharply. And because oil is traded globally, even relatively small changes in demand can move prices significantly. That's because oil markets are extremely sensitive to supply and demand expectations. If traders believe China's demand is increasing, oil futures often react immediately, and higher oil prices ripple through the entire economy. There are several reasons why China may increase purchases of US oil. The first reason is diversification. China doesn't want to rely too heavily on any single region for energy. Secondly, is geopolitics. Buying more US oil can sometimes ease trade tensions or strengthen economic relationships. Third, price and supply dynamics. If US shale production remains strong and pricing becomes attractive, China may increase imports simply because it makes economic sense. And remember, the United States has become one of the world's largest oil producers over the last decade. That completely changed global energy markets. So, what happens to oil prices? If China suddenly increases demand significantly, oil prices could move higher. The reason why is because global oil supply is relatively tight in the short term. It takes time to increase production. So when demand jumps quickly, price usually reacts first. And higher crude oil prices often lead to higher gasoline prices, more expensive shipping, rising airline costs, higher manufacturing costs. That matters because energy costs affect almost everything in our economy. Food transportation becomes more expensive. Air travel costs rise. Consumer goods, just about all consumer goods, cost more to produce and deliver. And suddenly inflation pressures start building again. So this is when we talk about how this impacts inflation and the Fed, this is where it gets really important. The Federal Reserve watches energy prices closely because oil impacts inflation directly. If gas prices surge, consumers spend more at the pump. That leaves less money for retail spending. That leaves less money for us to go to restaurants. It leaves less money for us to go to concerts, for us to buy houses. At the same time, businesses face higher operating costs. And if inflation starts rising again because of energy prices, the Fed may hesitate to cut the interest rates in the future. That's why oil markets can influence your bond markets, the stock markets, the Federal Reserve expectation. Um, Energy prices affect pretty much everything in our economy. I've talked about that in previous videos, but we're going to do a quick pause, please. If you want more breakdowns like this on oil prices, inflation, the Federal Reserve, and global economics, make sure you subscribe and turn your notifications on. It really helps support the channel and keeps you ahead financially. So, who benefits and who loses in all of this? Higher oil demand creates winners and losers. Potential winners are going to be U.S. energy companies, oil producers, certain energy exporting states, some industrial sectors. Potential losers are going to be consumers paying higher gas prices, me and you. That's who loses. Airlines, um, transportation companies, businesses with high fuel costs, and politically, rising gas prices can become a major issue very quickly because consumers notice fuel prices almost immediately. Even if the broader economy remains stable, expensive gasoline changes public sentiment really quickly. That's why oil remains one of the most closely watched commodities in the world. So to wrap everything up, at the end of the day, China buying more U.S. oil isn't just a story about energy. It's a uh, inflation story. It's a consumer story. It's a global economic story because changes in oil demand influence everything: inflation, gas, markets, interest rates, and Federal Reserve policy. So the global economy is deeply connected, and energy markets often move faster than people realize. So if you found this breakdown valuable, make sure to like the video, subscribe to the channel, and comment below. Do you think oil prices are heading higher from here? This is Economics 101, your number one source for everything econ. Thank you.